Hey, Mark, welcome to the Buy, Grow, Sell podcast.
Hey, good afternoon.
Thanks for making the time to come on the show.
You're very welcome. Excited to be here.
Yeah. Mark, I know we're going to have a little chat about, I know you built up ConnectedYard and ultimately sold it, and keen to unpack that part of your life. But maybe I could hand over to you and you could kick off, give us a little bit of your background and ultimately what led you to sort of getting involved as a co-founder of ConnectedYard.
Sure, by all means. My journey starts at the age of 11, really. I formed my first company then. It was actually recycled newspapers. So as a kid, I went around the estate picking up newspapers in my go-kart and collected them and put them in the garage and started stacking them up. And then I would sell them on to a recycling company. And then I needed a second garage, and then I needed a third garage, and then it grew and grew. And my parents had to open a bank account, and I became this obsession of collecting old newspapers and recycling them. And the lesson for me was it was great to find product market fit at the age of 11 and some demand and actually build something up. But the lesson to me wasn't about the building; it was about the exit, because eventually the company was basically just hijacked by other more mature, proper companies from around the area who thought, what a great idea. And they took over the opportunity, and recycling became a thing in the area I was in. And so, my little local business that earned me a little bit of money died on the vine and became non-relevant anymore. So that was a really interesting part of a good life lesson at the age of 11. I then went on and started building companies for other people. And, as you build companies for other people, you kind of learn a lot. And middle management, I always think that the hardest job is middle management, because you're reporting to someone above you and you're working with people below you, and you're stuck in that sandwich trying to make a change. And it soon became obvious that what I was doing was building great businesses for other people, but maybe I should start building them for myself. And I think, I've always had entrepreneurial spirit from the early ages, as I explained. But making that move out of corporate life or into startup land is tough. And my advice to anyone who may be listening today is that if you're struggling with that, as soon as you do it, you wish you did it 10 years before. And it's always the way. And I think, a lot of things change. And for me, a lot of things changed when I sold my first company. And you do things happen in most peculiar ways. The first thing happened to me was I lost a third of my friends. A third of my, because I think the notion there was, I'm in corporate life. Mark's doing a very high risk thing. It'll never work, and it's best if I stay in corporate life and earn a salary. And then when you change that model and you turn it on the head, and you're one of the few, because it's not many that do have a successful exit, then that gets people talking. And some people don't understand it. Some people embrace it. For me, I'm always about success for other people too. There's not a jealous bone in my body. And so I thrive on that success for myself and for others. And so to help with that now, and what we're doing with our venture studio is really important to me. It's about part of that experience. It's part about seeing companies grow, scale, and thrive, really.
Yeah, that's awesome. And I'm curious about, and I've chatted to a lot of entrepreneurs and business owners over the years. I'm kind of curious about how people evolve into this world and space. Like you started a business at a young age. Were your parents entrepreneurial, or was there any kind of model that you followed there, or did it just kind of come naturally?
I think it's the complete opposite. I think my parents were not entrepreneurial, and it's building success for yourself. I used to go on a bread round at 4 a.m. I used to work on the milk float with the milkman. I wasn't given money, so I earned money for myself. And therefore, when you do that, you find a way. And if you're inspired that way, I get your point. I remember at the age of 16 being interviewed by someone from IBM who sat me down and said, "So, Mark, what's your 5-year plan?" Now, you talk to a 16-year-old about a 5-year plan without any kind of like modeling or preparation for that. That's a big reach. That's a big ask. And so
totally.
I get the entrepreneurs that have seen success by by having mentors in their life that really helped them through that. But for me, it was the other way around.
Yeah, yeah. It's interesting what motivates us to want to go out and do something different. And as you said, you had friends who perceived what you were doing as risky. And I mean, obviously that was probably for later businesses. I think as a kid, you don't have much to lose, and why not? And it's an opportunity and it's exciting and stuff like that. But it is fascinating. And I can relate to your story. I know as a kid, we didn't have money growing up. It was, there was a lot of struggle. And, I do recall a number of times as a kid looking around me and seeing how other people lived and thinking, do you know what? Like, I actually want a better life. I want to, not necessarily have, I've never been I really want a Ferrari kind of guy. Ferraris don't motivate me, but it was more sort of what I would deem as a quality of life, this idea that they could travel or they could go see things. And I was always excited about what was over that next hill. And, unfortunately, if you want to see over that proverbial hill and that's on the other side of the world, well, it takes resources to get there, right? So, that's certainly always motivated me. Yeah,
that's a good point. I think for me, unfortunately you get to a point though where you're unemployable because I think what you're alluding to there is about having your own control and having your own destiny. And
totally.
deciding for yourself. And so that's great, but you get to a point where you can't then convert back.
Yeah. I very much relate to that. It's, there's, to me, in fact, it's sort of a bit of a running joke internally at Exit Advisory Group in our core business. Everybody identifies as a corporate escapee. It's and it's often bandied around that sometimes you've got to work in an environment so what you don't want for the rest of your life. So I know when I quit my last corporate job, and I was it was a great role in a big US based company, and it was I was well paid and all that sort of good stuff. And when I told people I quit and literally just packed up the family and went traveling around Asia for a year, they'd look at me like I'm insane. Just like. And people would go, oh, geez. And about the third time I heard this, that people saying to me, oh, geez, you're very brave, aren't you? And I'm like, why do people keep saying that? Like, to me, it's not bravery. It was just I didn't see that I had any other choice. I mentally couldn't keep doing what I was doing over there.
Yeah.
And I needed to do something completely different. And so it was just, to me, it was just the obvious step.
Yeah.
But, I take your point. I certainly couldn't go back.
Well, I mean, the way I go back now is with corporate innovation. I mean, it's nice working with large corporations that have a pain point and a problem area. And you can support that and join the board and be part of that process. But to actually be there, a cog in the wheel, I think it's tough to go back to.
Yeah. Oh, look, I think the difference, you're coming in there as a trusted advisor, not a cog in the machine. And, you're not reporting to some mid-level manager or somebody who, to be honest, can have different agendas and motivations. So, different sort of angle, I guess, that you're coming at it from. But anyway. So tell us a little bit about ConnectedYard. What was the business? What did it do?
Well, before ConnectedYard, I built a successful business which we sold to Alcatel-Lucent, Nokia, which brought me to the USA. And I think that really helped position ourselves, and myself especially, in terms of understanding what it is to build companies in a much more mature way. When we built the UK company, the notion that you could get local funding out of the UK for international growth was hard to get. And in the end, after growing organically and building a sizable business, we ended up selling through Alcatel-Lucent, now Nokia, who was a mature business that understood an exit strategy and understood an earn out of 2.5 years to actually grow the business internationally, which we successfully did. So that brought me across to the US and settled me here in Silicon Valley. And so ConnectedYard, to answer your question, was really an opportunity where it was one of those days where I was literally sat in my backyard and we had a neighbor over and we were complaining about pool techs and about swimming pools. And we were saying, there just had to be a better way of managing the pool. The pool tech would either not turn up, or you weren't sure you're getting value for money, or you couldn't put the chemicals in yourself because you weren't sure you were going to turn your kid's hair green, or what was going to happen. And so it came from that practical realization that there was something that needed to happen to disrupt an industry. And what's more importantly, and what I learned previously, is that what you need to do is disrupt it in a positive way. Negative disruption is always more difficult. It's more problematic, especially if you try to sort of bake yourself into an ecosystem and really get under the skin. And so we had to disrupt a pool industry in a positive manner and keep all the players happy. And so we, sitting down and looking at that, you have the pool techs. How do you make sure they stay the heroes? How do you make sure that the fathers of the households, the husbands are the heroes and they're keeping their pools clean? How do you make sure the chemical companies are still selling their chemicals, et cetera, et cetera? How does the retail not feel cannibalized by online? So that became an interesting problem point.
Interesting. And so note that you co-founded. So talk to me a little bit about, so you partnered, how many people started the business with you? What did those sort of early days look like?
Well, it was the two of us. We basically sat down, and I've got a photograph still of the whiteboard where we wrote down everything we needed to do. And we went, okay, well, let's split it in half. There isn't this sense of, okay, well, you're going to be the CEO and I'll be the COO, and we need to, put hats on and decide what we do. Obviously, if you're working with a technical co-founder, then it's pretty obvious. Technical co-founder's got to build code, build hardware, build software, and you're going to do everything else. But in a situation where neither of you are a tech founder, then you have to carve it up and just build an organization around that. So what we found, and what was really interesting, especially here in the Valley, was that you could employ some really incredible talent on a sweat equity basis. So that you literally just got, an incredible Google robotics engineer who would come in for 2-3 months on a small scope of work to build, a little interface, a hardware software interface as an EE, electronic engineer, and to be able to build that capability. And therefore, we couldn't afford cash because cash was in short supply, like all startups. And therefore, being able to dole out small amounts of sweat equity to these amazing people in a really sort of fast-paced, exciting environment like the Valley is, and was really the fundamental building blocks to begin the business.
Yeah, that's. I'd love to pick on that a little bit if I could, because I think you've sort of started wandering into an area that I certainly see a lot of confusion in the market around, and that is, how much equity do you actually give somebody?
Yeah.
In a startup, it's like, well, I mean, how do we even value this thing, or how do we offer something that's attractive enough for this person to come on board, but we're not giving away everything? And I don't know. Do you have an approach to that?
Oh, totally. I mean, we put 200 odd companies have been through some of our online learning materials now, and you get to see a bunch of those, and you start to see a pattern forming. And what's really interesting is that pattern is very much a single subject matter expert with a great idea who starts to put this together and start to build a plan and execute on that, and starts to think about, can you use no code, Bubble.io or something to actually build a minimal viable product. And then suddenly he needs someone else to come and join the business. Maybe he's not very good at sales, maybe he's not good at other technical implementation. And that second sort of co-founder, as you say, comes on board. It's a really difficult position, because if somebody like I was in my backyard talking about a problem point sits down with a co-founder, then you're equal 50-50 or 45% each and 10% to an option pool. But once you get to the point of a minimum viable product and it's got some value, then it becomes difficult to bring on people. And I think this is what you might be alluding to. What we see quite often is that founders end up promising the world. And again, unfortunately, we see that at Australian companies where they'll actually, it won't be a 4-year vest with a 1-year initial cliff for all people, including the founders. It'll be, set up the company and we'll go 50-50 each. And you just own the shares. And then as soon as that starts growing and you start bringing on investment money, if one person's leave, then you're left with this cannibalized cap table, which is really difficult to then sell into the VC community. So my advice really to summarize that is that either start really early and find yourself as a complementary subject matter expert and go 50-50 from the beginning and ideate from there up, or build the company by yourself using small amounts of sweat equity to build the business around you. And then once you get to the point where you think you need a head of engineering, a head of sales, or someone senior in the business, but you still can't afford to bring them on salary, then consider actually doing the sweat equity thing, but just paying them as a multiple on their salary earnings. So if you value the company at 2 million, you divide it by, their cost per hour, and you work out what that percentage should be. What it normally always equates to is that 5% mark, that golden 5%, where it's really, you're looking at bringing on somebody 5 years vesting over 4 years. Sorry, 5% vesting over 4 years. And then if it's somebody really incredibly talented, like a CTO who's joining you earlier, then you can put more equity into that.
Yeah, that's really interesting. And just, I guess, for those who may be a little bit new to some of this terminology, can you just explain what you mean by vesting and how that would work?
Yeah, of course, by all means. One of the most important things about any company is that there's skin in the game for everyone involved. And what I mean by skin in the game is that you don't own the business 100%, and the investment comes along, and you could just walk away from it and leave it empty, an empty shell. You've got to allow the business to grow, and you've got to grow with it. You've got to earn your right to own the business over that time. So it's very common for co-founders starting a new business, set up a Delaware C, 10 million shares, 4.5 million shares each, 10 million and 1 million sat in an option pool for staff over time. But the vesting is that 4 years where you earn the rights of the shares, and they unlock themselves over that period. And you would normally have a 1-year cliff, because sometimes it doesn't work out too well in the first year. So you don't want to be giving away big lumps of money. It's not working out. So you would normally have a 1-year cliff where you work for a year, and if you walk away, you get nothing. But if you're really seeing an opportunity grow, and you're getting under the skin and building it and showing value as a team, then you keep your shares, and you start then maturing them on a quarterly basis after that.
Yeah. Thanks for explaining that. I think anybody who comes from the corporate space, and I know I was in that situation of actually getting shares allocated on a regular basis. They're used to this idea of vesting, but I think for those in the private sort of space, it's, I see a lot of people coming even to us saying, hey, we're thinking about an employee share program, and I've heard that this can be really good for retention. And that's really the depth of their knowledge. Where do we start? Well, actually, there's 1,000 different ways you could slice and dice that. So, obviously understanding what they're trying to achieve and where do they think they're going to go. And in fact, I actually had a meeting with a couple of guys yesterday who I was saying to them, like, you've spent a lot of time talking about getting this program done and all that, and that's really exciting and great. But you keep saying that this is the retention piece for you. And I said, I just would caution you not to fall into this trap that once you've got an employee share program, that retention is a tick box thing. It's done now. I don't need to think about culture and environment and
that's
all that
really
stuff.
Good point. And when you're transitioning there is from a sweat equity, which is normally common shares, into an option pool, which are an option to purchase, and those options to purchase can be worthless, because it depends what the strike price is to begin with. You have an option to buy it for $1, but maybe it's only you'll ever sell for $1.50. You're hoping it's going to sell for $100. And the whole reason for doing that is for tax efficiency, etc. But those options alone never keep and retain staff. As you say, it's that culture, it's the ability to grow, and it's the ability for the people to see change. If you look at ConnectedYard, what we did there, that culture was really, really well managed by my co-founder, who really baked a sense of teamwork and ability for everyone to join the business. When we say to join the business and you're looking at shares, that's another key thing: is, are you coming to a company and you've got 2 mortgages, 6 kids, and you need 98% of your is cash, and you're giving a token share ownership, or are you single and living at home, these are just examples, of course, just extreme examples, and you can afford to gamble 50% of your salary, your total, on an equity position. And so it's always good to find companies that if you want to work for, or if you're a company looking to bring people on board, really working to those strengths of those individuals and making sure that you can support them that way.
Yeah. Look, that's a really great point, and the use of the word gamble is, and fundamentally there's risk, right? There's risk, particularly in early stage businesses, and I do agree with you. It's people need to be rewarded, and here I'm going to steal a quote here from Dan Pink, who I think describes this really well in one of his TED Talks. But he sort of says money's a motivator, but only to a point. Like once people are actually earning enough money to take money off the table as a day-to-day issue for them, I mean, sure, they may want more, but they're not stressed about money anymore. Their focus and motivation is massively dependent on other things, purpose and autonomy and mastery and all this sort of other stuff. And so I always took that away when I start thinking about building our own teams, that, I'm much more talking about purpose and the really deep intrinsic motivators. And money sort of comes down to that. Well, look, if we fit with all that other stuff, like, what do we need to do to tick the box of money, right? Like it's because you can't train people on that other stuff, right?
No, and that's also a really good point from a venture perspective as well, because venture capitalists can be hard and it could be difficult, but at the same time they understand the skin in the game, as I was explaining earlier, and therefore sometimes you've got to take some cash out of it. And what we often see is startup founders who sweat equity to begin with. They gamble their mortgage on their idea. They keep promising their partners that things are going to get better, and they build a business, and they pay themselves a minimum salary, and then get to a point where it's a growth stage. Actually, there's nothing wrong with asking a VC to put some cash in their back pocket as well. And so, taking 10 million on a Series A, why can't $1 million go to that and actually allow the founders to pay off mortgages, etc., to get onto the next part of their life?
Yeah, absolutely. Yeah, take the money issue off the table a little bit, right? And I agree with you. I think I've seen it myself in terms of, I actually need to make my partner happy. I need to reconcile the sacrifice that's been made as a family, and so
it's the internal culture again. It's the internal culture again.
Yeah. So you started ConnectedYard with a mate. Talk me through the first couple of years. I think I've done a few startups myself, so I've done that, really running really, really hard and pouring a lot of effort and energy into the business and not having any income. But what did your kind of first couple of years look like?
I think for us, what's really important is to understand is that we were tackling a hard problem, and with that came hardware, and with that came direct to consumer. And the world's learned a lot about hardware and direct to consumer over the last 5-7 years, and we're right in the middle of that whole point. In fact, we're just there before the bang. And so if you're trying to build hardware, you're trying to build software, you're trying to build an ecosystem for chemical delivery, a service network, and building all these kind of capabilities around it, you'd need funding for that. But more importantly is actually understanding how the funding should come in, because as much as you may have great talent and great expertise from a previous startups and confidence from the VCs that you can do it again, it's all down to that ability for that company to get product market fit, get traction, and scale. Obviously, they're not looking like a bank. They don't want a completely de-risk opportunity, but they want to de-risk it as much as they can in the available time they have to go through and review your pitch deck. So for us, what we did is we went for a pre-seed round, which was marketing only. It was $200,000, and that was to basically prove that the market was there and demand there for the product. So we used every single penny of that on building an incredible website and then pre-selling the product.
Yep. So just to clarify my understanding here, so had you built a prototype? Did you know that the hardware side of things would, in principle, work and all the rest of it? Like, where were you at in that side of things?
Concept stage. I mean, yes, of course, in the background we were building an amazing looking product because we use that for the filming, for the marketing. We had an understanding of BLE and transmission and how we're going to take the data for the floating device in the pool and relay it to the cloud. We had an understanding of what the website should do and how the app should work with some visuals of it. So yes, the principle was there. And so there was a lot of work in the background in sweat equity point of view, actually building prototypes. And those early prototypes obviously are scary looking things and don't work well. And I think the first one was literally a piece of floating foam with a plastic tray in the middle with a Raspberry Pi or something stuck in the middle.
You're totally right. Well, you got to start somewhere. I get that.
Exactly. But what was interesting there is that what we're trying to prove is demand, and therefore, and with that demand, we could then go for a seed series, and build from there and build a team around us. And what we didn't I think we expected it, but we weren't sure it would happen, is that we pre-sold $1 million worth of product.
Wow, nice.
And the problem with that is it's a nice problem to have, but then you've got to deliver on that. Yeah. And so, we executed on our KPIs. We pre-sold the product, and we proved there was a market. We then went back to our investors and to new investors to say, well, here it is. This is the opportunity. We now need seed money. That seed money came fairly easily, and it came from the Valley here, and it was from really great VCs that really understood the problem, especially from the hardware space. But then, of course, that those pre-sales are aging, and they're sat there, and your consumers need to be told that the money's been well spent, and you will get this product eventually. And for us, building prototypes and having something that's electronic, that floats in water, that can bubble around in a hot tub as well, 110 degrees, and can transmit data and can analyze chemicals. It was a tough ask. So the time
that is a very tough challenge.
So the timescale for delivering that product was elongated. It grew, and there with that came that demand from consumers. And so what we found is that initial marketing drive, which was direct to consumer focused brand proposition of selling this to consumers, became a rescue mission with social media to put out the fires. Where it's like, will I ever get this product? I think it's a rip-off. You guys are scamming me. And you learn fast, you learn hard, you learn about being transparent, being honest, showing the inner workings of the company, tell them what's going on, offering a refund if needs be, and just helping them through the journey. And then in the background, working really hard to deliver a product you can actually get to market.
Yeah, that's a really interesting insight there, that sort of delicate balance between, building and iterating and still trying to engage customers and prove traction. And oh man, it's an interesting one. I've seen a number of pitches and angel investor presentations over the years and everything else. I'm curious, you mentioned your first raise was all marketing, and I can see why that was a logical choice. But I also see a friction there, certainly as a guy sitting in the crowd and, people pitching me, I've thought so many people, I think, say, I've got a great idea. Here's the potential size of the market. Everybody's talking hockey sticks, you're sort of just waiting for the hockey stick. How steep is the stick, And so maybe after the fifth presentation, you're becoming a little bit cynical. But I do see a lot of startups out there who that whole sales, marketing and sales part of their model is perhaps not as well developed in thinking as the actual product itself, right? They know they can do some good tech stuff here, but how do we actually get clients to come in and pay us? And like I'm thinking of a guy particularly at the moment that he was asking for a couple of $1 million. He goes, look, we're just going to go, this is all marketing. We're going to go and get clients on board. And I just thought, you've lost me here. Like if you're just going to advertise or whatever, and maybe that will work. B2C is a little bit different as well. But I just thought, geez, that just doesn't sound like a really clear, concise, where your customers are and how you will engage them. So I don't know. I mean, do you see much of that? I mean, I think a lot of companies fail in that whole marketing sales piece, but it's
totally.
What's your experience?
Well, I think the first thing is that as a founder, you are a salesman. And if you're not a salesman, you've got to learn to be a salesman. And the word founder-led sales has to be drummed into your head, and you've got to write it on your forehead and look at it in the mirror every morning and you clean your teeth. Because without that, a lot of things can't happen. First of all, there's no feedback loop in terms of, is the product really being accepted in the marketplace. Secondly, there's a lack of confidence from the investors that you can actually execute on this one. And thirdly, you have to do that. You have to have sales as the main motivator in any organization, because at the end of the day, that's what it's going to deliver on. And quite often it's been valued on an EBITDA or some kind of multiple to actually exit it. So founder-led sales is really vital, and that can be a struggle sometimes. We do see that. And it's something that it's got to be learned. It's something that's got to, founders got to get confidence in. And more importantly, it's something you can't let go. Even when you're a stage where maybe you've been a founder-led sales kind of founder in Australia to start with, or a different country, and you've come to the US, and you go, okay, I'm just going to have a head of sales, and they can just run themselves in the US, and they can scale it. It doesn't work that way. You're back to 101 mentality, where you really need to start from the beginning again, and use founder-led sales to actually investigate the opportunity, the different customer personas, the different type of opportunities over here, and scale and start again.
Yeah. I love that insight there, because I certainly, I mean, look, we're a number of businesses over the years, and I think every time we sort of iterate or we start driving either a new product or a different brand to do some stuff, I literally said this last week to somebody, I feel like I'm back in startup mode on certain things. It's like, oh man. and as you know better than anybody, startups they're hard. It's if it was easy, everyone would do it, and it probably wouldn't be worth as much. But it's it's a challenging one. Can I change gear here? I'm cognizant of your time here, but it's
of course.
I know you started, co-founded ConnectedYard in 2014. Talk to me about the sort of back end. What year did you sell, and at what point did you guys start thinking about your actual exit?
That's a really good question. I mean, you get to a point where you prove it's all about KPI growth and proving you can use the money wisely and deliver on those promises to your investment community, to your customer base, to your internal team, and keeping a great culture both externally and internally, reducing your brand damage and building something that you can execute on and knock out of the park. Yes, all of those things. You get to a point where that growth, we got to 5,000-10,000 unit sales, and then you're into that growth stage. How are you going to then maximize that growth stage? Do you go for a Series B to really, put the pedal to the metal and go for it, or are you looking for an exit? And for us, we investigated a Series B growth round, and what we found is that the interest we got was to be acquired rather than to invest.
Gotcha.
And so it became difficult. It became difficult knowing when to let go of the baby and when to let go for your investors as well. Will this thing implode eventually? Because like any new marketplace, competitors come along. Are you going to still have your moats and your white space around you to defend that off? Are you still running ahead of the pack and delivering upon that? Or do you get to a point where you need to look at an exit that maybe helps you gain the momentum? So for my first company in the UK, that exit was with a major organization that took the software and implemented it to every telco around the world. That was our execution plan. On the back of that, we had a great multiple exit, and that worked out very well. For the next one, it was either taking in more investment money, and who would be the lead, who would want to lead that investment, or would it be actually corporate funded and exit that way? So that's what we did. We took an exit through a major pool manufacturer to actually sell the business out over 2 years based on an EBITDA earn-out opportunity and exit that way.
Yeah, interesting. Really interesting. So I get the trade sale part. I think that makes an enormous amount of sense too. When you structured the deal, I typically find all the deals I've been involved in that, there's really a couple of buckets that most people get their consideration. Cash up front. There's a deferred component, but not at risk. Otherwise called vendor finance. There's an earn-out, clearly deferred and at risk. Sometimes people get shares in a buying company, but I find a lot of, certainly my clients in the past aren't looking at that as an option. But did you get a breakup into those different buckets? Like what did the sort of, without going into anything that might be sensitive, but what did the sort of deal look like?
Well, let me just talk in more general terms about this.
Yeah.
I think one of the key things here is that, for my first deal, there was cash up front, and the rest was earned out over a period of time.
Yep.
For the second deal, it was very different to that. Every deal is different, and it's all about what you want out of the opportunity. And that's the way I'd really answer this by saying, first of all, can you trust the earnout? Do you think you can put all your eggs in one basket and believe that the acquirer would really deliver upon their promise and give you the team that they say for expansion and be able to achieve that? Be very careful with those kind of things. The second thing is around, if you give too much cash up front, then there's no motivation for the founders to stay with the business. So it's the opposite side for the acquirer, especially if there's a long handover period. You see, really, the pendulum swings so much. I mean, here in the Valley, you see a lot of acquisitions where the companies are bought. There's a 3-month handover. It's all cash up front, and the businesses are then just ripped apart. The components just absorbed into the larger entity, and it moves on from there. So really, you've got to decide on what you want and what the acquirer wants. Is it just literally an acquisition, break up, and move on? Are you too personally invested in the problem? I mean, are you running a company that actually you want a 2-year acquisition? You want to be a senior part of that team moving forward because you're inspired by the mission and the goals, and you want to stay with it. And all that really plays into it, and that's why it's really important to understand the motivation behind these deals.
Yeah, that's fantastic advice. I think coming back to sort of almost full circle on what we were saying before, money's important, but only to a point, right? It's, how important is the next stage of evolution of the business, and is legacy important, right, to you at all? And it's funny because I've had clients at one end who say, I don't care, it's just an asset. Like yes, I feel, I have feelings about my business because I've spent so much time in it, but ultimately it's an asset, and when they buy it, they can do whatever they want. And on the other end of the spectrum, I had a client once who took the lowest of 3 offers because they said, these guys get it. They get my vision, they get my strategy, and I believe they will continue to build it in a way that I believe is appropriate.
Yeah.
And there is no right or wrong with this stuff, right? I think there's probably a few very serious internal kind of looking and internal conversations for a lot of entrepreneurs and business owners to sort of answer some of those questions.
Absolutely right. I think you need to go into that with the same kind of methodology when you first start, because every day is a burn day. Every day is important, not only for your company's growth and the loss of that the money you have in the bank to execute on, but also it's another lost day for you in terms of what you could be doing. And we quite often see this where I'll talk to a founder, and they'll say, well, this is the mission, this is what we're doing. I said, this sounds great, but it sounds like a lifestyle business.
Yep.
And they say, well, yeah, it is. This is what I want to do. So, well, how are you ever going to attract investors? And how are you ever going to look for an acquisition? And those two sometimes are a knife edge in terms of deciding what you want to do with the business. We recently had an amazing lady who came into the studio, and she was looking at this. And what she realized is she could build an amazing business around corporations and enterprise that had nothing to do with her vision, but the money she made on the corporations and enterprise, she could use to execute on her vision. She gave her the best of both worlds.
Yeah, interesting. Really interesting. I think the takeaway here for our listeners is that, your point you made before, every deal is different. And even though, deals might follow a similar pathway with some similar kind of typical milestones that need to be cleared, I mean, your business, the people within it, the buyers themselves, they're all different people with different perspectives, different views. Even the timing in the market and what's going on around you is going to be different. So it's not that sort of thing that you can just take a basic run sheet of what's happened in the past with somebody else and just apply it consistently to your business.
Exactly.
Yeah.
And two other points I'd make on that very quickly is, number one, make sure you've got a good measure of the VCs that are backing you and what their motivations are as well, and making sure that you have a clear communication along the way with your VCs about how you want to execute and what their return is and when they expect to return. So often we see it happen where that conversation happens far too late, and the founders have lost controlling interest. The VCs are pushing them for a localized IPO exit, and the VCs will get out, take their preference shares, and make a multiple, leaving you with a shell of a business afterwards. And then what do you do with it? And so having clear communications with everyone in the value chain, the stakeholders here, is really important, especially with your team internally as well, of course.
Yeah, great advice. Mark, so you've got out of ConnectedYard. You've obviously, it's all a relative thing, but you've done well in life with all this sort of stuff. What are you doing these days? How do you spend your time, and who are the sort of people you work with?
That's a great question. We, I think 3 years ago, after finishing with ConnectedYard and looking at next things to do, it was, do I roll the dice again on a startup? And do I have the stamina for it? Well, the answer is yes. I think every day I get up and I'm just driven. Don't understand the word no horizons. Just keep going and going. But at the same time, is that the best use of my time? And after a lot of advice from friends and family and colleagues in the industry, the opportunity to set up a venture studio was just too much to turn down. And so what we've done now is we've created an incredible sort of unique venture studio, in that, first of all, we're not an accelerator. People get confused with accelerators and that 3-month cookie cutter sort of going through a program. We're a kind of bespoke studio where we handpick companies we work alongside with for small amounts of sweat equity to actually be co-founders as a service almost, to help them with a problem and to grow it from there. At the same time, we still ideate on our own startup ideas, so we still haven't lost that edge. We can still come up with great ideas ourselves and build teams and execute on that. And then thirdly, working with government entities around the world to help them support the startups in those countries to basically be able to launch here and grow. Quite often we call it bouncing off the atmosphere, where the companies, they think they can come into the USA, but they quickly find that they bounce back and they don't know why. They may have spent a lot of money and didn't quite understand why they couldn't scale. And so we get a lot of satisfaction out of that, especially out of UK businesses, because of my background. My co-founder's background is Australian, so Australian businesses, and now from other countries as well.
Yeah, awesome. Oh, man, that sounds fantastic. And it sounds like a great use of your experience and skills, and adding a lot of value to your clients. So I do have one more question before we wrap up, and and really it's something I'm curious about with all of the sort of entrepreneurs that I get to speak to, is really how you personally define success. And perhaps I can leave that sitting out there for a moment and get you to answer in a moment. And before you do answer it, are you okay for people to reach out and connect with you? Like, how do people find you? If somebody's got a burning issue, what's the approach?
Sure. I can be found on LinkedIn. No problem at all.
Cool. LinkedIn's the go. So we'll put that. We'll put a link to your profile in the show notes here.
Find me through LinkedIn.
And
go on.
Yeah, cool. And I always like to say here, if people are going to reach out to Mark, please don't just send him a connection request. Just please, if you're maybe going to connect, at least put a note. Let him know that you heard him on the podcast. That give him a little bit of context, so it's not some random kind of social media thing. But anyway, we'll include all those notes, Mark. To finish off, how do you view success personally?
So let me answer that in quite an interesting way for you, because it's not about the money, it's not about the success, it's about what you deliver to your community around you, and how you've basically made the world a slightly better place. And I say that even when I was working for companies, I've got this story which I say to so many people, where I had a young lady who joined my production company as a runner, And she joined the business and she grew in the business. And one day she left the business and became a successful national wildlife producer. And she's now going around the world and delivering on incredible documentary stories and got a hugely successful life. I've had other people
Nice.
that come to me and say after working for a while, hey, I'm leaving. And to me, that's not, oh no, where are you leaving? I can't bear, to see you go. It's great. You've got to move on to something better and bigger. And so
Yep.
that internal culture is a major part of it. Is how can you bring on people in your life that can grow and mature and then go on to do great things for themselves. For me personally, that's a great motivator for me. Obviously, being successful and paying the bills and be able to keep the dog fed is important as well. But I do think one of the most important parts is seeing other people's success and making sure that you can make that difference on a day-to-day basis.
Yeah, love it. Love it. It's, and a great place to finish off here. We've mentioned it a few times through this discussion, but money's a motivator, but only to a point. And after that, I think it's, I totally agree with you, that having an impact and knowing that you're contributing in a positive way to other people's lives tends to be a lot more fulfilling. So, Mike, thanks again. I really appreciate you giving us your time. You've been very gracious and, appreciate you sharing your story with us.
Not at all. Nice to meet you. Thank you very much for your time.
Cheers. Thank you all for listening to another episode of the Buy, Grow, Sell podcast. I hope you join us again next week.